May market update. Welcome. Let's have an absolute time. So May market update, because we're in the month of May, but it's actually an update for April stats. Okay, and what kind of story can we tell as we embark here? So if you're looking to buy, sell, invest, whatever the case may be, whatever you're looking to do, hopefully this gives you some insight. We'll try to keep it short-ish today. Okay, so here we go. No surprise. You don't need to read the title. Sales activity is down year over year. Okay, so I'm going to put my head over the title. No surprise, sales activity is down year over year. Now, stagnation, really, a lot of stagnation. There hasn't been much change in 18 months, and we actually saw a bit of a surge for the spring market last year in 2023, simply because the Bank of Canada alluded to the fact that we were going to start to kind of ease the rate hikes. That's all it took. That's really all it took. Okay, is the news. Pardon me. It's just like if Elon Musk was to say today in an interview or on a podcast, if he said, hey, we've perfected the self-driving car and AI robots that can fetch your groceries and fill your fridge, that share price is going to go up simply based on the information and the outlook of what's to come. We don't have to see any of those AI robots or actually have those cars available for sale yet. But the fact that that information is out there has an effect on buyer behavior and seller behavior, if you will. So the same is true in real estate. 2023, we had a little glimpse of resurgence in 2023, March and April, which right now we haven't yet seen our spring. I think our spring market hasn't even hit. Okay. Generally, we see the spring market hit right after March break. We haven't seen that happen yet. Reason being is there's been no reason to entice buyers to take action and for sellers to sell, right? Of course, real estate always moves. There's reasons why people have to sell, buy and sell, personal reasons. But there hasn't been any reason to accelerate those numbers. So, we're down like nominal, nothing crazy, nothing even really worth mentioning. The big story here is the stagnation. So, you can see between 23 and 24, we're down nothing. For the most part, it's that stagnation. And what we can kind of pull from this information is we know we've hit the bottom. We know the bottom is ultimately behind us, or at least we're in it. We're in the eye of the storm, if you will. It's going to get better. The transaction volume is going to get better. There's a ton of pent-up desire for sellers to sell. They just don't want to sell at these market prices. They want to wait a little bit for the market to come back. As soon as we see a reason for that market to come back, we are going to see an immense amount of transaction volume growth. So it could trickle in toward the latter end of, we'll call it May. But June 5th, big date to keep an eye on. Interest rate announcement right now, consensus is split 50-50 if we're going to see a hike or remain the same. Okay, but anyway, it's important to know the main takeaway is the stagnation. Now, inventory is up year over year because it's taking a little longer to sell. If transaction volume is down, it means the existing inventory is taking a little bit longer to sell. Okay, so you can see the graphs here to the left and the right. Residential months of inventory. So how many months of inventory we have? We're below 3, which is it's a normal market. Okay, and new listings. We're on pace with, again, a normal market. So it's neat to look back at the 15, 16, 17, 18. We're kind of in and around there in terms of the new listings, but the absorption just isn't quite the same. The action, the urgency just really isn't quite there yet. Major takeaway for me here, the major takeaway is relative to the craziness we saw in COVID, this seems slow. Our market seems to be moving slow, but in actuality, this is a balanced market. So, we're not seeing homes sell in 3-4 days anymore. We're seeing it take the standard 45 to 60-ish days when priced right. And that's normal. But our perception of normal kind of shifted during COVID, okay? And we've been somewhat stagnant ever since. I'm very excited about what's to come. We're not going to recover like this. It's not the flip of a switch. Obviously, this inventory, these months of inventory need to be absorbed before we actually see asset prices appreciate. So assuming we see a rate cut June 5th, which I'm hopeful. Let's see what happens. I'm hopeful. Then I think by September, October, we're really going to see the prices start to take effect, and 2025 is going to be a wild ride. Okay? So this is a little breakdown. You can pause it here if you want to see the asset class activity. I won't bore you if it's irrelevant to you, but you can see kind of the asset price breakdown. And again, the big takeaway for me here is understanding how the market reacts to specific asset classes. So right now, what we're seeing is a lot of first-time buyers, condo apartments and single one-bedroom units. It's a little slower. The absorption's a little slower because first-time buyers don't have to buy necessarily. Some of them do. They're moving, but slower than anything else. And they're a little more risk-averse to this market. They haven't seen it before, right? The millennials, maybe whatever gen they are, Gen Zs, they haven't been exposed to a downturn. It's always been, real estate, real estate, real estate, real estate, real estate. They haven't been exposed to a market downturn yet. And because of that, they're a little more risk-averse, a little less willing to take action. But if you see in the freehold market, especially that, we'll call it $1 million mark plus minus 200K, they're really moving. They're really moving. Even the detached market. Why? For the most part, homeowners, existing homeowners, it's irrelevant if you're buying and selling in the same market. Not entirely, but for the most part, it's irrelevant if you're buying and selling in the same market. I've lost $100,000 of equity. I'm getting $100,000 in discount on what I'm buying. Who cares? It's a buy and a sell. It's less relevant. Okay, so growing families that need to move up, still doing it. Separations, still selling. There's still properties, there's still markets that are transacting. It's kind of the downtown Toronto condo market that remains the softest market. But I mean, basically it's not rocket science. We can make these predictions based on how we understand people and the dynamics behind these statistics. Okay. It's cheaper to move up right now. If you're looking to move up an asset class, it's actually a lot cheaper to do so when rates are higher, right? That asset class gap decreases. The gap to move up decreases. But the big reason why I think these stats show the way they do is the mentality of the buyer, okay? The buyer profile. First-time buyers, a little more risk-averse. They're not quite sure if this is the right move yet or if this is the bottom yet. As much as we can say, they need to wait to see that market's going to tick back and end up paying more later, which, it is what it is. But we're seeing more risk aversion in the first-time buyers and that entry-level buyer profile than we are in the ones that are selling something and then buying something, or buying something and have something to sell. Okay, that's it in a nutshell. Employment numbers, obviously something important to look at. Again, you don't need to see the title. You'd rather look at me, I hope. Unemployment rate, no major change. We're up from where we were, we'll say 2 years ago, which that's the point of the rate hikes, is they want to slow the economy as a whole. Okay. What's interesting though is that you can't stop this machine that is the GTA. What's so special about it? Well, the employers want to be here. Why do the employers want to be here? Because the employees want to be here. There's a lot of job growth, a lot of job creation, a lot of employment opportunities, and we're adding a lot of jobs. We're adding a lot of good quality, high-paying jobs, specifically in the tech sectors. Finance sector's a little bit soft, but in the trades, in the skilled trades, holy smokes, we need skilled trades. So long story short, we are seeing the unemployment rate over the last, we'll call it 2 years, tick upward, which is the point of the increased interest rates, but definitely not at a point where homeowners and tenants can't afford their debt. Okay, so we'll say the homeowners are definitely making it work and servicing the debt they need to because they have their jobs, because they're earning an income. So, as I say, the worst is behind us. We're done. We're over it. Inflation, look at this. This is exciting. Okay, so inflation's working its way down. We know this for the Bank of Canada to be considering a rate cut. We have to see inflation work its way down. The target inflation is 2%. Bank of Canada wants to see 2% inflation. We're working our way down. It's a lagging indicator. We are under the circumstances that we are, and inflation will continue to reduce. Even if we do start to cut rates, it's not going to spike back up. Okay, but there's other elements in this bucket, oil being a big one. Okay, geopolitical kind of issues in the world, and 2 of the 3 largest oil producing regions. It's not all COVID effects. It's what's happening in the world as well. So, again, BMO says we'll see a rate cut. CIBC says we're going to hold. We don't have that crystal ball, but what we can do is form our own opinions based on the stats we see. And what we see is, holy smokes, this inflation is looking real good. We're working our way down. We're feeling good. We're feeling confident in where we're at and what's to come. Okay, sub 3% inflation for 3 consecutive months. And, now it's been, I think, 5 consecutive months. So pretty good stuff, pretty exciting stuff for rate hike. Well, it depends what side of the whole thing you're on, right? A rate hike could be, or sorry, a rate hold could be favorable to you to give you more time if you're looking to buy in the fall. A rate cut would probably be more favorable to most of you, more access to capital, better opportunity for investment, and the cost of ownership decreases. So anyway, that's what we've got for you. That's our market update. I'm trying to keep it closer to 10 minutes for you guys now. Keep it short and sweet. You can speed this up too. I'm telling you at the end of the video, but going forward, you can watch this in double time, as if I don't already talk fast enough. But yeah, our predictions going forward, we're probably, I'm split. Personally, I'm split 50-50 on if we're going to see a rate hike or a hold on June 5th. I'm maybe 51% rate cut, 49% rate hold, but anyone you talk to is going to be split. They've got their own reasons for it. I think it's kind of been long enough, and we know inflation's a lagging indicator, so it's going to take time no matter if we keep rates where they're at. Inflation's going to continue to work its way down. What do I see? I see a delayed spring market. I think things are going to really ramp up in June, whether we have a rate cut or not. I think that there's a lot of pent-up desire to make moves, and people have been waiting longer than they want to because the market hasn't been in a spot that favors them. But life happens. Okay, life happens. And as I say, when you're buying and selling in the same market, you can only kind of put your life on hold for so long. So we've seen stagnation for, I would say, 18 to coming up on 24 months now, and we're ready to see the recovery begin. Okay, and I'm extremely bullish, especially on the downtown core, but the GTA as a whole. I'm very bullish on the real estate market come June, the latter half of the year, but especially in 2025 and 2026. So, you can't time the market exactly. It's very difficult to do. But from now until probably September, October, you're going to have a really good window here to make some investments and move up in asset class, and we'll kind of see where we go from there. But, 2025, 2026, it's gonna blow you away. So you've heard it here first. Hope you guys have a great long weekend. And as always, give us a call if you have any questions. You know my number, 647-991-2432. Call me. Happy to chat and discuss kind of what's going on in the real estate market. So have a great day, guys. Have a great weekend.